This morning, I went into the previous videos that we have done for this boot camp series, and I really appreciated the favorable reviews and the fact that people were getting something out of these. And of course, that's all we are about, is trying to help you be a better educated investor. And then hopefully that would lead to you also being a more profitable investor. Some people, unfortunately, are well educated, but find it difficult to pull the trigger. And of course, those are the people that very often need somebody else to help them. Unfortunately, our role is just to be teachers of what we find the best information to help you. So here you see in our first slide, the first slide from our first in this series where we talked about this difference between stocks and bonds to make sure that everybody understands how important stocks are. Then we moved from there to look at 10 major equity asset classes and why they could, all of them could be part of your portfolio. I wouldn't say all of them could stand alone as a portfolio, but as a part of a group, they have lots of history that would suggest they can be in the portfolio. Then we moved on and looked at 9 different ways to combine those 10 equity asset classes. And I want to thank you. Many of you have written to me and asked questions about different ways that one might configure those 10 different asset classes. And I am in the process of posting some of my responses to those folks. Give me a little time. I have been overwhelmed recently with projects, but I'm getting there. Now, we follow that by what I think is, in many ways, the most important of all of the decisions that you're going to make. Certainly, the decision of stocks versus bonds, that is a multi-million-dollar decision. But what I want you to be able to do as an investor is to be able to find that balance between stocks, equities, we often say, and fixed income or bonds. And the reason that is important is because that is the moment of truth for you to figure out as a do-it-yourself investor how much you want to have in stocks looking for growth and how much you want to have in bonds looking for stability. Remembering that at the end of the day, it is about a combination that will help you stay the course. And so I think this decision is very important, and it's a tough one for do-it-yourself. As you walk into an investment advisory firm, and they'll probably ask you a bunch of questions that are trying to get at that same point, and that is, if you have too much in bonds, you may not get the return that you need. If you have in too much in stocks, you may overexpose yourself to loss when the market's going down. I got a haircut yesterday. I don't know if any of you noticed, but I did. And the young fellow who was cutting my hair, I talked to him about investing, and he just doesn't want any part of the stock market. And the reason he doesn't want any part of the stock market is because he's afraid of losing money. And so this PowerPoint and this presentation is about letting you see the impact of the different combinations. And by the way, I'll tell you something this presentation is not. Many of you know what a glide path is. When you own a target date fund, you have a glide path built into that target date fund. You may pick a target date fund that says you want to retire in 2065. So the managers of that target date fund, if you're 21 today, know that you should have all of or almost all of your money in equities. But when you are in 40, at 40, age 40, they're going to see reasons to start adding fixed income. And maybe by the time you're my age, 80, you may find some of those target date funds have you 30% in equity. Some of them have 40% in equity. So they too have to make decisions about how much you should have in stocks and how much you should have in bonds. But by the time this year is over, my hope is if you are not, in fact, investing in a target date fund, that you will have created a glide path. That's coming as we can get to all the things we want to do to try to help. Now, please do not be worried that you have to be able to see these numbers. But I want you from 30,000 feet to understand why this is one of the most powerful kinds of tables that we have developed. These tables go back to the 1990s, and every year we have updated those tables. And what you see here, if you just again from 30,000 feet on the left hand, we have the years from 1970 all the way down to 2023. Then as we move to the right, we see what was the return of a short to intermediate bond fund, government-based portfolio. How would you have done if you had invested in only 100% in bonds? And this will be real important later when you look at the accumulation tables and the distribution tables. How much you have in bonds is a big, big deal. Now, notice as you go down that you have bond returns sometimes up 15.4% in 1970. And then I'll go way down here to the bottom, 2022, worst year, not only going back to 1970, but going back to 1928 for this kind of bond, but it was a 9.9% loss for the year. So you have all this information if you thought that you wanted to be all in bonds. I'm hoping that you will move to the right, and in moving to the right, you'll see that 10% is in equities, 20% in equities as we move further to the right, 30, 40, 50, 60, 70, 80, 90 to 100% equities. So we can look, and we will look at some years in just a minute. We can look at how these different combinations not only performed for you, not in good and bad times, but then what they did to you in the worst of times. We'll look at that at the bottom of this table. We're going to go zero right in on that so that you can see those implications. And down the entire right side here, we have the S&P 500 on its own. And right next to it, to the left, is the S&P 500 as we see it in this particular portfolio. The next portfolio I'm going to show you is not just the S&P 500, but the S&P 500 with small cap value. And then you're going to be able to compare the two. And what I am hoping that you will come away with is an aha moment that these pages of numbers give you some basis. Remember, we have no idea what the future is going to bring. So there's no way I could create a table for the future. But I do believe that if we show you what I would call a long history of results, that it will give you a sense of the range in the good times and the bad times. So let's move on to the next table here. Now you can see the numbers. You'll see that this is table B1, and there are 9 of them. The next table that you will see when we move into the S&P 500 is, and small cap value is B9. And in between B1 and B9 are all of those different portfolios that we talked about in the Sound Investing video. So now let's just take a look at one 10-year period so you can see what you can learn here. For example, in 1970, the S&P 500 was up 4%. Well, there was such a thing as the S&P 500 starting in 1957. It was created and tracked, but wasn't managed. What you see here in 1970 is the result of the academic work that was done looking back at what the S&P 500 stocks did in that year as suggested since 1957. And by the way, keep in mind that S&P 500 is actively managed. Actively managed, I know, because of every year they replace about 20 of those companies in the S&P 500. So this is not a track record of the same 500 companies over the last 50 some years, but it will give you some idea of what it might have been like. And it doesn't matter if it's exactly what might have happened to the market in 1970. It is just a look back at what we would call a representative return of that period of time. In this case, large cap blend, some growth, some value, but large companies. Not all of them name brands, but most of them. So what do we see? We can see that in 1970, the S&P 500 was up 4%. We can go over here to the bonds and see that bonds had an amazing year, up 15.4%. Now, I don't even know the reason it was up 15.4%, because the first thing is that the future will never exactly be the same. And so what we see here will just show you that you could have a lot more volatility in bonds than you might expect, and you're likely to see it in the future. But I can see that's a huge difference. What I like to do then is to a couple of things. I like to see what happens to the return if I add a little bit of stocks to the bonds so that you've got 90% in bonds and 10% in stocks. Well, remember, because the stock market didn't do very well, the more you add to the bond portfolio, the lower your return is going to be. Now, if we just go to the middle, and I've said it many times, my wife and I, our portfolio is 50% in stocks and 50% in bonds. And we'll talk more about the risk implications. And I don't want to make too much about any single year, because we are not talking about investing by the year. We're not even talking about doing it by the decade. We really want to think in terms of very long periods of time, because the returns become more normal over long periods of time. But I do see in that particular year, a 50-50 portfolio did pretty doggone well. But it was because of the bonds, not because of the stocks. And that's going to happen sometimes, not often. Now, we don't normally look to bonds for big returns, and I would be willing to bet that very few predicted that bonds would be that strong in 1970. So as you look down, let's just look down the 50-50 column since we're there. Notice the numbers, up 10, up 11.5, up 12.1, down 4.6. Now, that down 4.6 was not because the bonds had a bad year, although they didn't make a lot. They made 6% compared to some much higher earlier years. But it came because the stock market was down almost 15%. Now, when I say the stock market, we'll see a different stock market when we start adding other asset classes. This is one of the things we really have to get a hold of emotionally, is not to expect a broadly diversified portfolio of big and small and value and growth, U.S. international, to look like the S&P 500 1 year at a time. But we do see this, that the combination of the 50-50 lost 4.6%. Now, I can imagine if somebody had retired at the beginning of 1973 and had looked at the previous years, and by the way, lots of good years in the 60s as well, that they might have felt comfortable having a lot of equities in their portfolio. But then the reality of how the market performs hits you here, and it can be down. And it's down about 1 out of 4 years, or 1 out of 5, depends the period that you look at. Well, here it was actually down 2 out of 2, because in the following year it was down 26.5, but the 50-50 strategy was down 10.6. And as we see the rest of the 70s, you'll notice that the 50-50 returns were pretty good. There was a loss of 2.2 in 1977. And that's because the S&P 500 was down 7.2. Bonds weren't up very much, 2.9. And I'm just saying, from everything that I have learned, having been around the market before what you see here happened since about 1963, that it isn't possible, or certainly isn't probable, that you're going to know how to outguess what the next year or even the next decade is going to do for you. But what we can do is we can see the impact on our portfolio if we took some money in stocks and some money in bonds, and we would see, and you'll see this later, that the combination was a heck of a lot better than the bond only. And that's one of the points we made very obvious in the first video of this series. So this is how these tables work. And as we go to the next table, still the S&P 500, but from the years 1990 through 2009. Now, there's a couple of reasons why I wanted you to see these 20 years. Because if you look from 1990 to 1999, just look over here at the S&P 500, which is in both columns, and you'll see it was an amazing period. In fact, while there was a loss of 3.1% in 1990, look at all of the amazing years, up 30 in 71, I'm sorry, 91. In 1995, up 38, up 23, up 33, up 28, up 21. I mean, it was an amazing 5 years in the latter half of that 1990s decade. And it was also a period that bonds only had one losing year by chance. It was also a year that the stocks didn't make very much in 1994. So your 50-50 combination lost 1%. Is that enough for you to give up investing and just put your money in CDs? I doubt it. Because you will have been the previous years having a decent performance. Maybe you might say not great, but look where it was great in a 50-50 strategy. Being a conservative investor, which a 50-50 investor is, I am one of them, to be up 26, 13, almost 20, almost 19, over 10. What a period. And it was at the end of this period that people then concluded that in the future, in the next decade, the S&P 500 should compound at over 20%. And of course, we've talked about this a lot of times. That next 10 years was not a pretty period. It had 4 major losses: 2000, 2021, 2001, 2002, and 2008. That was not an easy decade. And while you can't compute it easily, we all know that was called the lost decade. And people lost money, about 1% a year, compounded in the S&P 500. But if you were 50-50, you did have three losing years, excuse me. And those losing years, one of them in particular, down 16.7. And by the way, as you're going to find out in just a few minutes, that's not the worst outcome you should expect in a 50-50 strategy. Because I want you to know what that worst outcome was over this last period going back to 1970. But again, this decade is so different from the previous decade. All of a sudden, fixed income has a lot of years it didn't do very well. I mean, it made something, but not very much. And we were counting on it. You may forget that if you go back to the 80s, there were people who put all of their money in T-bills because T-bills were paying over 12% for a part of that period. And people concluded, why should I ever put money in the stock market when I can get 12% in T-bills? And many of them didn't actually realize that inflation was taking most or all of that extra return. That's a whole other thing we need to understand. But you can see over many years the upside and the downside, and to know what this process is going to look like. But down at the bottom of this table is what I consider to be the real magic in terms of learning something that I hope you will really believe is representative of, let's just call it, the rest of your life. And what we haven't done in this table, and something that we're going to do this year, I know that Daryl will be happy to accommodate us on this one. I'm going to focus real hard on the worst of times. Maybe too hard, maybe so hard it scares you. Well, let me just tell you, the best of times were amazing too. But let's just look at what the bottom of that table offers you. It gives you the ability to look at the compound rate of return of the 100% in bonds. And then I jump over here to what I know is the 50-50, which is a 9% compound rate of return. I know that at the beginning of this whole period, 1970, that most, if not, almost all investors would say, if you can get a 9% in stocks, that would be amazing. That would meet my needs. But in fact, a 50-50 stock bond balance portfolio had a phenomenal long-term return. And if you were in an all stock portfolio, 10.7. Now, it doesn't look very different, 9 and 10.7. But when we look at this period of time during accumulation, and we look at it during the distribution period, you're going to see this difference between 9% and 10.7 is a ton of money and a ton of risk. You're going to see that right here. I'm going to look here, and the standard deviation, as I think most of you know, is a measure of volatility, and the higher that number is, the higher the volatility, and you're about to see that higher volatility in this table. Notice the worst 6 months for the 50-50 was a loss of 22.2. Notice the worst 6 months with the S&P 500 was a loss of 41.8. Now, that is based on looking at every 6-month period, starting with January 1970, starting then with February 1970. So it's a lot of periods. And what we know is that if you are 50-50 on a short-term basis, as well as, by the way, the worst 12-month loss was about the same. And the same with that's the 50-50. If the all equity portfolio had a worst 6 months of 41.8, its worst 12 months was 43.3. So it looks to me like this pain could last for a while. And in fact, I'm going to show you another way of measuring pain that really gets to people, and that is the drawdown. But before we get there, let's also looking at the 50-50 here, let's also look at the worst 36-month period, 3 years, starting again with every month along the way. What was the compound rate of return? The worst, 4.6% loss per year. You go out 60 months with the 50-50 strategy, you would have lost 1% a year. Was the worst experience on the downside for the 50-50 strategy. Well, look at the 50-50, the all equity strategy here over the worst 60 months. That's 5 years. Was a loss of 6.7% a year. That would be more than most retirees could take. And why this should come as warning to a retiree who gets all excited, as many did after the 5 years of the 1995 to 1999 S&P 500. Recency bias is really an interesting bias that we deal with. Following the herd, another interesting bias that we deal with. There's overconfidence, another interesting bias we deal with that can trap people into putting themselves into a position where they think this is okay. And finally, I want to talk about the worst drawdown. The drawdown, we've talked about it before, that's from a peak to a valley. Now, there can be a lot of stuff going on between that peak and go down, up, down, up, down. But getting back to that most recent high, it hits the bottom and then it turns around and comes back up to be even. During that period of time from that peak to the valley, that is called the drawdown. It could theoretically happen in 3 months, 6 months. It could also happen over a period of 2 or 3 years. So it is not attached to any particular period of time, but it does tell us if you had a certain combination of asset classes, looking back at index returns, not at somebody's ability to dash in and out of the market because they claim market timing would have saved you, or active managers who picked a few of the best stocks. It's not about that. It's strictly about buy and hold with a broad market index, which is the way most of us should be investing. Now, from there, we now know how to use this table. So as we move to table B9, B9 is the fine-tuning table for that two-fund strategy that's half in stocks and half in bonds. I'm sorry, half in the S&P 500 and half in small cap value. And now we have the ability to use this far right column. You don't have to do it right now, but we're going to be able to look at the S&P 500 versus the two-fund strategy 1 year at a time, 1 decade at a time, 5 decades plus at a time. We are able to do some comparison shopping here as to what it would have been like with the S&P 500 and this two-fund strategy. And then we can also see the two-fund strategy as it relates to the bonds in those same combinations. And of course, we're going to end up looking at this bottom section, that same concern for the downside. So here we go. Here's going back to that 1970 to 1979. you should not be shocked to see that the combination of those two classes, small cap value and large cap blend, lost money in 1973 and 74. Would have been nice if the combination of small cap value had taken off while the S&P 500 went down. That does happen sometimes, but not often. Okay, what do we know? We know that over this period of time, there was a 22.7 and 21.9 loss in the combination of the small and the large versus the large only a negative 14.7 and negative 26.5. So they weren't the same. They were both bad. And notice, if you had a 50-50 strategy, you lost money, 9% in 73 and 7.9% in 74. But you had some great years with the combination. I mean, how would you feel after having lost money for 2 years? And boy, I'll tell you, if you've lost money with a 50-50 strategy for 2 years, you know what's coming next, another bad year. And in fact, for the next 2 years, the combination of the S&P 500 and the small cap value produced 25 to almost 30% returns. It was fantastic. That's 50-50. If we looked only here at the all equity portfolio, it was a gain of 51 and 40 for that combination. It was a tremendous time for small cap value. By the way, one of the characteristics historically is that when you come out of a bad bear market, small cap value can take off like a rocket compared to the S&P 500. No guarantees, I promise. All right, let's look at that period from 1990 through 2009. Again, you're going to see, well, in fact, here, 1990, just look at the equities. S&P 500 down 3, 100% combination of S&P small cap value, 50-50, was down 14.1. Well, it shouldn't be a shock because the small cap value itself, historically, on average, has about a 14 or 15% difference in return on the upside or the down from the S&P 500. So it's never a surprise to me to see a wide variation. But what we can see is that you had two with a 50-50. You had a loss in 1990 of 2.5%, and you had a loss in 1994 of 1%. Relatively harmless. Now, what we also know about that particular decade is the S&P 500 got to experience that huge 1995 to 2000 to 1999 a return of 28.2%. I think it was compound rate of return. Well, it wasn't that productive for the 50-50 in fact, in every one of those cases, because you diversify between the S&P 500 and the small cap value, you made less. And I guarantee you, by the end of 1999, there were articles questioning whether or not it makes any sense to put small cap blend or small cap value into your portfolio, because look what just happened. Recency bias, following the herd. I mean, all of those things, thinking linearly. It was normal for people to give up. But in some ways, they were giving up on the upside, not because of the downside. And you can be trapped by that feeling of, I can't stand it anymore, from losses and seeing your neighbor making more money than you are, buying cars more often than you do. I mean, I don't know how you measure how they're doing, but you can see they had their money in the S&P 500 probably instead of that small cap value. It didn't help. It hurt but that's normal. Okay, let's go down to the B9, the bottom. Now, what you're going to see is, and again, remember we had the 50-50 strategy here. Well, I'm not going to talk about the S&P 500 on its own. I'm going to talk here, just except to compare here, if you will, to the S&P 500 10.7 and the combination 12.4. That's a big difference. Remember, every 0.5% is worth for many people, whether they're in their 20s or the 30s or even their 40s, can be over $1 million from their portfolios based on how much they have in equities and how much they have in large cap and how much they have in small cap. But this was a 50-50 balance coming out with 12.4 rebalanced once a year. But look at the downside. It's all the same pain. It's all, in fact, here's the worst drawdown, 27.7% versus 55.8. Now, I really want to make it easy for you to make those comparisons. So here are those same B1 and B9 right there. You can compare. Here, right here, 50-50 S&P 500 bonds, 9% compound rate of return over the entire period. Right down here, it's 9.9. So almost a 1% advantage. But you had to take more risk. The question is, how would you feel instead of having the worst 6 months, 22.2, it was 24.9? Or would you even know that? Probably you wouldn't. Most people would only know what happened to them, not what happened to their neighbor. The worst 12 months, 23.2 for the S&P, the combo, 25. Let's just go down to the drawdown. Oh, well, let's look at the worst 5 years, 60 months. Down 1% for the S&P 500, 50-50 with bonds versus down 1.2%. Not much difference. And with the worst drawdown, 50-50, minus 27.7 versus minus 25.5. And that difference, I don't think, at the end of what could have been many, many, many months of decline, that it would not have been noticed as a difference, but you would certainly know you're down a lot. And by the way, don't forget, this is without taking distributions. And if you were taking distributions, that would mean that it was falling a lot more, because at the same time you were in decline, you were taking money out, and you will see that when we look at the distribution tables in a few weeks. So I think having these two tables to compare will help you think through this relationship of risk to the return difference. When I see the difference in those returns, of course, it's easy right now to say, oh yeah, I'd be willing to take a little more risk to make an extra 1.7%, no question. But first, I want to make the point that it was over a long period of time, over 50 years. And so we don't know the difference between seeing it on a piece of paper and living through it. They are very, very different. So before I close, I just want to talk about what I hope you got out of this presentation. I hope you have a more realistic understanding about the implications of how much in bonds and how much in stocks. And to do that, I want to go back for 1 second, because there's one more thing that I think is important to see. Because I have focused on 50-50 and I have focused on 100% in equities and 50-50 bond stock. But what could we learn? And I didn't share it. I want to show it now. I want you to see what happens to the return in the fine-tuning table that has the two fund portfolio. It shows the annualized return for all bonds, 6.7. By adding 10% fixed equity, it would go up to 7.4. A 0.7% increase because you added 10% in equities. Now, remember when we looked at the ultimate buy and hold strategy and we went from all the S&P 500 and we put 10% in large cap value? It pushed the return up. I think it was 1/10 of 1%. This is more. This is big. This is life changing for somebody. Maybe it'll be for your heirs, but I'm just saying that here is an area that fine tuning is a big deal. If you could accept the possibility of a loss of more, instead of a worst 12 months of 10.5, go up to a worst 12 months, 12 months of 10.6, you lost 1/10 of 1% more by adding now 20% in equities to the 100% in bonds. That's a big deal. But you have gone up from 6.7 to 8.1% compound rate of return over a very long period of time. And the risk, even though standard deviation is up a little, the risk is virtually the same. You go another 10% in equities. Now you've got a change. You have basically increased the worst 12 months by 50%, from 10.5 to 15, worst case loss. Big deal, because the return went from 6.7 to 8.7. And if we go out 60 months, notice the worst 60 months was a gain of 1.1% a year, as opposed to losing money once you go beyond that. I think when I have met with people over the years as an advisor, which I don't do that anymore, but when I did, when I ran into people that just had no tolerance for equities, I don't want to lose money, I would drag this out and say, how about at least going to 20% equity? Give yourself a chance to pick up 1.4% and have risk characteristic that is actually in a way better. Because I want you to see this. The worst 60 months with the all bond portfolio was a gain of 0.3% a year. With 10%, it was a gain of 1.6%. With 20% equity, a gain of 2.2%. It's only till you get to the worst drawdown. Remember, drawdowns don't have any particular relevance to the period of time. Anyway, I hope that is another lesson worth picking up on. Now, I have been answering questions, not as many as I want. I've been sleeping more lately. I used to get up at 3 and 4. And now I'm starting to get up at 5 to 6. I don't know what's happening here, but I'm a little worried about it. And but I have a lot of questions I need to answer in the coming weeks. But as you send me questions, in fact, when this video, you're going to see it, you can leave the questions in the comment section, and you can leave a comment for others to read that tells them who this might be for. You might say, this was a great piece for engineers only, or for whatever you want to say. Be honest, but the fact is, those comments that you make are really helpful in getting other people to take a look. Unfortunately, We also get comments from people who are selling trading systems or whatever it is that they're selling that have nothing to do with what we're trying to get people to learn. But I guess that's just one of the problems of dealing with the internet. You got to wade through that too. So next time, we're going to start talking about accumulation, fixed contributions. What does it look like? If you compare the returns of all of these portfolios, and there are 9 of them, some of them the S&P 500 by itself, the small cap value by itself, the S&P 500 and the small cap value, the 4 US, the 5 all value worldwide. I mean, there are all those different strategies will be laid out in a similar tables as we just looked at, except instead of seeing returns per year, percentage returns, we're going to see the impact of starting with $1,000 in the first year, and then each year raising that by 3%. And how does that look from 1970 through 2023? I think they are remarkable tables. They have some great lessons for what the ride might be like, regardless of what portfolio you might put together. Because a lot of you people, I know what you're doing. You're taking information from me and other people, and you're putting together your own portfolio. That's great. But I'd like you to kind of pick one of those portfolios that we have there that might be kind of like yours and follow the bouncing ball down that period from 1970 to 2023 and how much money you would have accumulated at the end of 10 years, 20, 30, 40, 50, 54. I think it will help a lot of people. And I think it will give you a sense of hope if you're not really ready for an all equity portfolio. You're going to see it with 50-50. How would it have done? With 90% fixed income, 10% equity, how would it have done? Again, an opportunity to see the past, hopefully to learn from it. That's what it's all about. And you're what I'm all about in this project. And I appreciate you being with me here today to see this information. Again, Paul at paulmerriman.com. If you got a comment or you got a question you don't want to put on the comment section of the video, but let me just say, I'm personally not in a position to give personal advice. Sometimes I give a nudge. But when you send me a question, if you also include the telephone number, I guarantee you I will never call you and try to sell you anything. I have absolutely nothing to sell. I have a bias to share at no cost, not to sell. Although I guess I am. It's just the price is really low. Your time, by the way, is the price. But yeah, email me, include the phone number if I have to clarify your question, because many times I want to use your question. I'll never use your name in one of our Q&A segments. And I'm a little short of Q&A segments right now because my dear friends Daryl and Chris are out for a couple months. So I'm doing this all by myself. I'm not complaining. I'm loving every second of it. I just got to figure out how to get less sleep. See you soon. Thanks for spending the time.